Excellent. Well, good morning and welcome. My name is Teresa Campbell, and you have joined the PIM and PIA Mid-America Financial Executives Council program on sales tax nexus compliance. Now, before we get started, I want to note that all of our attendees are placed in mute mode so we can ensure a quality recording, which will be provided to all of our members. We encourage comments and questions during the program. You can type them in the Q&A field at the bottom of your screen, and they'll be asked at the most appropriate time. We ask you to communicate any technical difficulties in that chat field, and we'll address those separately. The Financial Executives Council is coordinated by leaders in both the North Central and South Central regions of the United States. They guide the programs on content offered 6 times a year, and the focus is around financial reporting and compliance, data management and security, and financial policies and planning. Our council co-chairs are Carl Nathy with Myers Printing, Ken Rain with Daily Printing, Ryan Wagner with Action Mailing and Printing, and Matt Wills with LB Carlson. Matt, let's get started.
Thanks, Teresa. So today we welcome our presenter, Rob Yonkers from LB Carlson, to the Financial Executives Council meeting today. Rob is a tax partner in LB Carlson's Minneapolis, Minnesota office. Over the span of 30 years, Rob has assisted clients in the manufacturing and graphic arts industries through mergers and acquisitions, represented clients through audits of various taxing authorities, provides leadership and insight in corporate tax planning and compliance, and leads LB Carlson's state and local tax practice. So please join me in welcoming Rob.
Thanks, Matt. Yeah, we're here today for a Nexus update, and it's actually going to be on sales tax and income tax, probably more focused on sales tax. Excuse me, and some of you may have attended the webinar that we did. I'm guessing it was about 2.5 years ago. A lot of the content will be fairly similar to that, so you may be getting just a refresher on that at times. But the advantage that we have now is 2.5 years later, we have some history of some things that have happened. I'll have obviously some stories of various clients and I guess what they've done, what they've run into in particular situations. All right, and from that, we'll get started. We'll start with sales tax, and I know everybody can read, but just a brief history of kind of how we got where we are. The Supreme Court typically has taken a big part in deciding what states can do, and we've got the Due Process Clause and the Commerce Clause, and those two I guess clauses regulate what the states are able to tax on. So in other words, when we get to, when we get to the laws that have passed, or I guess the cases that have passed that have helped to dictate law, the Supreme Court has ruled that these thresholds, I guess, are not going to create undue burden on businesses to have to comply. Now, we can disagree with that all day long, because I'm sure when I talked 3 years ago and I talked about Wayfair versus South Dakota and the $100,000 threshold that most states have adopted, where you'd be required to collect sales tax, I personally think that puts an undue burden on all small businesses, and I'm guessing most people on here would agree with me as well. But in the Supreme Court's opinion, that does not put an undue burden on businesses, and therefore that's why the states are able to set the parameters that they are related to sales tax. Let's see, what is Nexus? And again, most of you probably know what this is, but we're going to cover a few of these things anyways. Nexus is just a connection between your business and a state. And if you reach a certain level of connectivity, that can require you to have to file a sales and or income tax return or a different type of return. Traditionally, before the Wayfair ruling was passed by the Supreme Court, or before, I guess, the Supreme Court ruled on Wayfair back in 2018, you only had to worry about physical presence nexus when it came to sales tax. And a lot of those items related to physical presence nexus are listed on this screen. But basically, I would look at it as property or payroll in a state, employees, facility, inventory, equipment, things like that. But then, as you all probably know, and probably the big reason why you're on here is because sales tax got a lot more complicated in 2018 when the Wayfair ruling came down. And you all probably know that that created a concept called economic nexus, which now requires businesses to track the sales levels that they have that are attributable to a particular state. And if you get above those levels, you're now required to file sales tax returns. You don't need to have a physical presence along for this economic nexus requirement to be there. You guys will look at this screen, and I have clients that sometimes laugh at me when I talk about this first one. Technically, and I say technically because this isn't always the case, and I'll cite a couple of examples, I think, of where this happens, but technically, economic nexus should not put anybody at anybody at a disadvantage. The theory behind that is, if you are a business and you are not, let's just say, since I'm in Minnesota here, I'm going to start using a Minnesota example. So let's say I'm a Minnesota business and I have a customer that is in, we'll just say, South Dakota because it's neighboring, and I ship $500,000 worth of goods to them. Technically now I should start complying with the sales and use tax laws of South Dakota and charging that customer sales tax. My customer, if I was not charging them sales tax in the past because I didn't have any physical nexus there and therefore wasn't required to comply with South Dakota laws, should have been self-assessing themselves use tax. Now, you're going to run into situations where your clients aren't self-assessing use tax. You're going to run into situations where we're going to talk a little bit later about exemption certificates, and there's different requirements on exemption certificates. So you could run into a case where you try to give somebody an exemption certificate, but that state won't accept the exemption certificate because you're not actually filing in that state and you're not able to provide a sales tax or a registration number for that state, and therefore you're being charged sales tax. So I say it shouldn't put anybody at a disadvantage, but the fact of the matter is that, it actually does. Comment number 2, I'm just going to say, it says states will be more aggressive. I still think that states will be more aggressive. I would say to date, I haven't really necessarily seen states be more aggressive. And I think that what happened is, between the time that the economic nexus rule passed and now, we had a little thing called COVID that I think derailed a lot of, I think, the states in setting up probably the way that they would like to govern and police the new sales and use tax rules. But I would anticipate that in the future, in the near future, that people would start receiving more sales and use tax nexus questionnaires, or I would just say nexus questionnaires, because typically the nexus questionnaires, they'll cover every tax in that particular state. And I would expect states also just to start sending out notices. It's been a few years, but I remember a handful of years back, Michigan was very aggressive in that they would just send out notices to people, and it only takes a few people to pay and not to inquire with somebody before the state actually is, I guess, stocking their revenue coffers. We're going to talk about what you should do in a minute to look at this. But there are amnesty programs out there, or I guess they're called voluntary disclosure agreements that you can enter into with most states. So I think most states would rather have you, rather than send out a nexus questionnaire, rather than come down hard on you, they'd rather have people just comply if they think that they have nexus in that particular state. And these amnesty programs allow you to look back a number of years, paying the tax, probably paying interest, and therefore come in compliance with the state. Now, a little comment on that. I will say that I haven't had, well, I will say I've probably had 4 or 5 clients that I know for sure that are up to date 100%. At least we believe they're up to date 100% on their economic nexus compliance. And they were all made aware of the amnesty programs, and every single one of them said they would pass on that for now. So, they're out there. I will say, like I said, of the clients that I have, and I would say, they range from clients that are risk averse to clients that are, willing to take risks. None of them thought the amnesty program, was worth entering at that time. One other important thing to note is that physical presence nexus still does apply to sales and use tax. So if we go back to my Minnesota, South Dakota example, let's just say that we're not South Dakota compliant, but we decide that we're going to have, I guess we're maybe close to the border of Minnesota, South Dakota. We've got an employee that wants to now work remotely. So now we have a South Dakota employee. We now have a physical presence in South Dakota, and technically we should be complying with South Dakota sales and use tax laws. And I guess I say technically, and I guess I'll go back and talk a little bit about the amnesty programs as well when I say this. A lot of this, as you're looking at the sales and use tax and the whether or not you should comply, a lot of it's going to come down to a business decision. I say technically because, again, if we're this Minnesota company and we've got a South Dakota employee, that gives us physical presence nexus, but we don't have more than $100,000 in sales. Is it really worth our time administratively to even worry about complying with South Dakota? And I would think most reasonable people would probably say no. Okay, I am going to do my best to toggle, and this is where I think some people may have even asked about this, but there is a tool, and hopefully Teresa or Matt, someone's online. Can you let me know now if you're actually seeing the Excel spreadsheet instead of the PowerPoint? You're
No,
not.
we still see the slide.
Okay. All right, then hold on here. Let's see here. How about now?
Yep, perfect.
Okay. All right. Good. So this is a tool that we've created that, again, we've shared with clients, and obviously after the presentation, just so you know, I plan to send this along with the PowerPoint to Teresa and Ben, and anybody who wants to have it can certainly have it. But we've looked at all the states. We've got in here, the economic nexus thresholds, how you're supposed to measure those thresholds, whether or not exempt sales count towards those thresholds or not. We've added in the rates as well. I will say that I know that this still isn't perfect because I was testing it yesterday. And what I mean by that is, in theory, if you look at Alabama here, they've got a $250,000 threshold. So in theory, if I were to punch $200,000 in here, and we had perfected this spreadsheet, it wouldn't put any liability in here for Alabama. Well, it still does. So you're going to have to look at these thresholds and determine. In this case, I'd say, okay, well, wait a minute, I really don't have a potential liability in Alabama. So next go around, we'll create a little add if statement to perfect this perhaps. But for now, this is what we have. But it does have the rates in here. It does not have, we could certainly have a discussion on, all right, and I'm going to continue on Alabama. And I'll be honest, I don't know if Alabama has a lot of local sales tax rates or not. But when you're looking at these sales tax rates, we're looking at the base rate in this case. It doesn't necessarily take into account local rates. So it's not going to probably give you a perfect view of it, but it's going to give you a snapshot. And again, I guess, what have I used this for? I've had clients, and we'll probably talk a little bit more about this as we move on, but had a client that somebody was approaching them to buy them. This wasn't a printing client. This was a client of mine that sold software. And this client did have Nexus in a few different states. We had talked to them about Nexus and the idea that they may have a liability. The purchaser in this case brought up the fact that we had Nexus in some of these states and wanted to know what our liability was. And I should take a little step back. I should say, excuse me, we had talked to our client, and we actually, before, as we knew they were going to engage in this, we said, hey, we talked about this previously, that you were going to have this liability. We should probably calculate this now. And we actually put interest and penalties on there so that you know exactly what your liability might be when due diligence happens. So anyway, it can be used for that. But I mean, I think in a lot of cases, I mean, the other thing we've used it for is, quite frankly, clients just to determine, all right, do I want to comply in this state or not? Is it, I've talked about technically versus versus business purpose, I guess. What is your liability and what is accumulating? The longer you run from it, the greater, I guess, it gets. Guess I'm going to take a step back and, I'll talk about that a little further on in the presentation. Never mind.
So while you're here, Rob, there are a couple of questions coming in.
Yeah.
What equals a transaction? One letter of 12 dropping in that state is 12 transactions, or 12 letters is one transaction?
Yeah. I mean, it's on an invoice level. So just the fact that you're sending, if you've got one mailing job and you're sending 500 letters, postcards, what have you, we'll go down to Arkansas, that's only one transaction. So it's the invoice level. It's not the number of pieces.
Okay. And this tool will be provided to those members who are attending the webinar via email from PIM or from Mid-America in the coming days. So know that you'll all have access to this. Now, Illinois brings me to a question where it says preceding 12-month period. And does that mean a rolling 12 months? And so every month we need to determine when we reach $100,000?
Yeah, I'll admit, I do not know the answer to that question off the top of my head. I believe the answer to that would be yes, but I certainly can look into that and find out. Yeah, I mean, usually what I've typically done, I mean, what I've found, and again, this is, we only have, the last 5 years, but what I've found is with my clients that have wanted to be 100% compliant, and, okay, I said there's 4 or 5 of them. That means I'll just tell everybody, I mean, I probably work with, I'm going to say 40 to 45 or 50 different businesses. That means there's others that I've talked to that either don't think it's worth it to comply right now, or are kind of waiting for the chips to fall to see what happens, etc. For those that we are looking back, or we're looking typically at a quarter by quarter basis. We're not looking every month. And we're usually are looking back, at a rolling. Does that mean we're complying right away? Not necessarily. I mean, it may be, all right, let's keep watching. There can be something. I mean, again, the next discussion that comes in is that, okay, well, shoot, we just got over the threshold in Illinois. But the reason being because we think we had one particular large job that we don't know if that's going to recur. So again, the business decision, are we going to worry about that or not? So this tool is meant to, I guess, help let you know where a liability might occur. But after that, I think you're going to want to have a discussion, and ask questions and find out, yeah, okay, we've got something out there, but do we even really need to worry about it? And the other thing is too, I guess as I look at this, I had another particular client, again, another client that was selling their business. And during due diligence, it came up that we weren't necessarily complying with sales tax in some states. A lot of those, and what my client said was a lot of those were exempt. Well, what did we do? We went back to our customers, got exemption certificates. Therefore, we were able to satisfy the buyer that we were in compliance, and that they didn't need to worry about the sales tax liability. Okay, unless there's any other questions on this, I'm going to go back to the slide deck. I'm going to try. So let's see here. Stop share. Slide deck?
Yes.
Perfect. Okay. All right. Yeah. So what should you do? And again, probably not rocket science, but use that. I would use that spreadsheet or some other method and calculate my potential liabilities. And I will stop at this point and say, hey, I did talk to a couple of my other clients that have complied, and this didn't offend me. They went to, because I will say, again, what am I going to talk about today? I'm going to talk about sales tax compliance, income tax compliance. As part of my job at LB Carlson, I handle all different types of taxes. I don't just work on sales and use tax. So I did have a client that said, hey, would you be offended if I went and talked to somebody else about getting in compliance for sales and use tax? Because that's all that they do. And I said to my client, hey, that doesn't offend me. You go right ahead. The interesting thing was, upon talking to them after they went through this exercise with an attorney that professed to just be a sales and use tax professional, they pretty much did the exact same thing that I'm telling you that you should do here. Other than they did a couple of other things, which I'll get into in a second. But they took the data that was available, and this was a mailing company, so they had to help them create this data. And when I say create this data, you mailers that are out there know that in a lot of cases, after a period of time, you have no idea what states you actually ship to. So what this particular company had them do was a couple of things to try to arrive at what potentially states they were over this $100,000 threshold in. First, they had them look back at the last 6 months because they still had that data available. They still had lists available as to what states that those items had been shipped to. And from that, they extrapolated that back. The second thing that they did is they said, okay, well, most of your customers are of the type that they advertise in all of the 48 continental United States. So they looked at the population of each state and basically extrapolated their sales based on the population. They kind of looked at those two and said, okay, are they both over the threshold? Is one of them? And just tried to come up with a reasonable way to determine where they were above that threshold, and therefore had a potential, the potential where they were over the sales tax threshold. And then they used the data and then basically extrapolated that back, to the dates on that spreadsheet to come up with what they thought those potential liabilities were. Since it was a law firm, and I'm not picking on lawyers here, but I mean, what they did then was basically just kind of more of a scare tactic and said, hey, you guys have $3 million worth of liabilities here. We think you should enter this voluntary disclosure program. What my client decided to do instead was they did actually, a fairly large company, they determined that they were over the threshold in 25 of the states, and they started to register and begin collecting and remitting tax in those 25 states. They've been doing that for about 9 months now. They haven't heard from any states. They haven't received any nexus questionnaires. They haven't, received any questions on why they started filing. but why, down to my next point here. And again, that's not to say that they still don't have some risk out there. I mean, I've got a comment down below. Why would you start filing? Well, there's the concept out there, and maybe you guys are all aware of it, called the statute of limitations. And that's the amount of time that any basically state or government entity has to come back and look at a filing that you made and determine whether or not it's accurate. The problem with that is if you don't ever file, a statute never begins. In other words, if you go through this exercise and you determine that you've got a liability in a particular state, you've had that since, let's just say, since 2018 when Wayfair came around, and you never do anything about it, well, theoretically, again, we'll use South Dakota again. South Dakota comes in, and they could come in 10 years from now, and they could go back all 10 years. What's the likelihood of that? I would say probably not very high, but that likelihood certainly exists. And that's why that's why you go through this exercise and try to determine where you think you should probably start filing. Okay, yeah, and I guess somebody already pointed this out, but it's less common probably for anybody that's on this call, but the number of transactions can create nexus. That's economic nexus as well. In a lot of the states, it's 200 transactions. And I've touched on a couple of these things here, but why do you want to review your sales and use tax obligations? If you have a financial statement audit, the day is probably going to come where your auditor determines that there's something they probably need to disclose in your financial statements. And that's could be a big ugly owie that you don't want on your financial statements. But the thing that I've run into more than anything else is merger and acquisitions. And I'm assuming that a lot of people on this call are probably baby boomers. And I'm just using the statistical data, and I think if you look out there, I can't remember the number, but I think it's still 65 to 70% of small businesses out there are still owned by people in, I think, the baby boomer generation. That you're probably going to be doing something with your business in the next few years, whether it's moving that down to the next generation, or if you don't have that type of succession plan, potentially selling your business or merging with another entity. Well, I can assure you that this is certainly going to come up as an issue in any merger or acquisition opportunity. We have a practice here at LB Carlson that does M&A work, and in every single transaction, this comes up. Other thing, just so you know, and again, I don't want to be here to scare people either, because some things we have been able to do. I guess I talked about one particular issue where sales and use tax came up, and how did we mitigate that? Basically by being able to provide sales tax exemption certificates. Another approach that we've taken that a lot of times clients are apprehensive to go down this road because they find it maybe embarrassing. But earlier on, I talked about the fact that just because you're not charging somebody sales tax doesn't mean that they're not self-assessing use tax. So if you're dealing with a customer that's of a particular size, they probably are complying with those sales and use tax laws. And you can go to that customer, and if they're willing to provide you something that says, yes, we paid use tax on these particular invoices that you had, that's another way to mitigate that sales tax. So again, clients are apprehensive to do that, but we've done that as well.
Rob, there's another question. Are there more aggressive states that have been performing audits on businesses that haven't filed in their states?
Again, not that I've noticed thus far. I have not. And I'm a little bit surprised by this, but I can't think of a state right now that has just sent a client of mine a blind nexus questionnaire and come at them aggressively. Historically, what states have been aggressive? Historically, it's California, it's Michigan, it's New Jersey, New York, and usually Texas. I mean, those are typically the ones that have been aggressive, in my 30 years of practice. But since Wayfair, and again, I think maybe it's related to COVID and the fact that that took everybody's attention off of maybe some of these issues. I haven't noticed anything in the past few years where there's been a particular state that has been bombarding my clients with questionnaires. So nothing that I've noticed as of yet. And was just going to bring up one other thing on the merger and acquisition thing. I did have another client. Here's another way that things can go. This was not a client in the graphic arts industry. This was a client that basically sold promotional materials. They knew that they had some sales tax liability obligations. We'd actually calculated them and were aware of them. And what happened in their case, it was about a $7.5 million sales price, and the buyer said, okay, well, we can see you didn't comply. That's fine. We're going to escrow roughly 5% of that sales price, which is roughly what they thought it would cost to pay somebody to get them to comply and to file the voluntary disclosure agreements to get them in compliance. So, again, I look at now what's happened in that case is the buyer has been too busy to do any of the work related to the compliance or voluntary disclosure agreements. And my client negotiated that if they didn't do anything within 2 years, the escrow was going to be released. So I think this December that will probably be released, but just kind of letting everybody know that's another thing that can be out there. And I think the reason why I bring that up is if my client would have, and in this case, it was 5 or 6 states. And I get that, again, it creates administrative burdens. It's a pain in the butt. I'm not in the business of telling people that filing sales tax returns are fun or that I would enjoy it. But in this particular case, if they would have complied, they'd have, 375. Well, okay. They probably would have paid somebody and had to buy a little bit of software. Let's just say they had a $50,000 investment. They'd have another $325,000 in their pockets right now. So.
Another question. Have you seen businesses that meet minimum necessary compliance requirements by requiring customers to self-assess instead of billing sales tax?
Yeah, repeat that question. Have I seen
businesses that meet minimum necessary compliance requirements by requiring their customers to self-assess instead of billing sales tax?
I have not seen that. No, I have not. Yeah, I don't, okay. I have had, I guess this is kind of the push down effect from the larger businesses. I have certainly had some of my smaller businesses that are considering complying because they're being charged sales tax because they're not registered in a particular state. And their customers are saying, well, I can't not charge you sales tax unless you provide me an exemption certificate that works. And the only way that works is if they are actually registered to do business in that state. So that I've seen, but I don't think, I guess I'm not quite sure how somebody could force somebody to self-assess. Let's see. There is something out there called the streamlined sales tax. And there are several states that are members of it. There's some good information on the website here. And the other thing that they do provide, and again, I have not had a client that has used this. Now, again, back to I work with probably about 50 small businesses. And when I say small businesses, I'm going to say that's ranging in sales from, 5 million to 100 million. I work with about 50 of them. Only about 4 or 5 have chose to comply. Those that have chose to comply, none of them have gone this route. Now, that doesn't mean that they may not, but basically, if you are in these states that I go back to, and these are some of the states that you are over the threshold in, there is a way, if you meet certain requirements, to get basically free help. And when I say free help with software and compliance if you meet these thresholds in those particular states. let's see. Yeah. Yeah, that's about all I have on the streamlined sales tax. But there are I mean, I guess the other thing to mention is if you do go to their website, there are some decent resources as well. But the main thing about them is, again, if you are and I've made my smaller clients aware of this, but because in general it might be those clients that would maybe meet these parameters, but there is a way just to get basically I would say free help. Okay, exemption certificates. I know that I believe that somebody sent a question in advance, and their question on exemption certificates was, can you rely on exemption certificates? I'm going to give the classic tax answer on that. That depends. I'm going to try to toggle to another document here. Let's see here that I'm going to show everyone. So let's see. All right. So Teresa, if you can let me know if you're seeing something that says uniform sales and use tax resale.
Got it.
Okay, cool. So there is a multi-jurisdictional resale certificate that's available out there. And actually it's got, I think there's 38 states that are on here. So we've got 45 states that have sales tax, 38 of them are on here. And what I did is I highlighted a few things on here as to why it depends. Why does it depend? Well, okay. And again, I didn't highlight Alaska here, but Alaska basically makes you call and check and make sure somebody has an exemption number in that state for that exemption certificate to work. Alabama says that the retailer is responsible for the validity of the exemption certificate. In other words, you can't rely on it. Arizona says, yeah, it's valid as long as there's an Arizona transaction privilege tax on it. In other words, it's valid if customer of yours has relied on it. Other states even say other things like, okay, Georgia, they'll just accept it. And let's see, I think they accept it as long as you provide the number from the state that you actually have nexus in. And I think Illinois says that you again need their an Illinois registration number. So it's kind of all over the map. I guess Minnesota, this is one case where Minnesota is actually somewhat taxpayer friendly, I guess, to people that aren't from here. But if you provide a state other than Minnesota's ID number, you can rely on it. So I just bring this up because can you rely on it? And I guess the answer is in some cases, yes. In some cases, no, which I know is probably not the answer that anybody wanted to hear, but there just unfortunately isn't any easy answer when it comes to exemption certificates. And quite frankly, like I said earlier, there just isn't an easy answer when it comes to sales tax because every state has their own rules, laws, etc. All right, I am going to try to go back now to the other screen.
So it's really that exemption certificate that potentially would make them not liable. We've had individuals say,
yes,
well, not.
Yeah, I mean, good question. Yes, I mean, and again, I'm going to say that depends as well, because in some states, if you go back to that tool that we had, in some states, exempt sales don't count. In other words, if you had, $100,000 worth of, and I can't remember. Well, let's see. Well, here, we'll pull it up and use an example. What the heck? Hold on. We'll toggle back to that. I'm starting to feel pretty confident that I can toggle back and forth and not screw up. So let's see here. All right. So if we go back to this spreadsheet and let's get here. So we've got, do exempt sales count? So if we sell into Alabama, just the fact that we have an exemption doesn't mean that we don't still have a filing requirement if we've got that sales tax exemption certificate. But if we sell into Arkansas and we've got a sales tax exemption certificate, well, then we don't need to worry about complying because those exempt sales don't count towards our dollar threshold. So again, that's why this is such a pain, and in my opinion, such an administrative burden on small businesses, because this matrix just shows how different every state can possibly be. And this doesn't even go into where are things sourced, what is taxable, what isn't taxable, is the shipping component of taxable, is it not? I mean, there's just, yeah, all kinds of fun things. So
would you say that in every state, they're primarily looking at the shipper as being responsible for collecting that sales tax?
yeah, so that your question probably goes to typically the sourcing rules. So the majority of the states do look at the destination sales as where the sales tax is required to be collected and paid on, and it is the shipper's responsibility to know what that destination was. And it depends on where, I guess, where title passes, right? I mean, if the if your customer comes and picks it up at your dock, well, then I'd say you're done with your responsibility. If you require a third-party shipper, or use the United States Postal Service, or use UPS, FedEx, well, then it's responsible until delivery, and you're required to know that destination, and typically required, if you have nexus in those states, to collect and remit based on where the destination is. There are a handful of states. Oh boy, what are they? Hold on. I think I have them written down somewhere else on my notes. The origin sourcing states where you wouldn't necessarily need to worry about the destination: Arizona, California to some extent, Illinois, Missouri, New Mexico, Tennessee, Utah, and Virginia. Those are the states where the destination isn't necessarily as large a deal. But that leaves, again, if we've got 45 states, that have sales tax, that leaves 38, or the vast majority of them, where you do need to worry about the destination. So
talk a little bit about using a client's shipping account number. So there seems to be some question out there that if my client provides their UPS number and we're shipping under their UPS number, then we no longer have to worry about reporting or being compliant because it's their UPS number. And that's not the case, correct?
Yeah, my general response to that is, and again, that's because it could be different in a particular state, but my general response to that is not true, is that, again, it goes back to what the sourcing rules are in that particular state. So just because I've used my client's United States Postal Service permit, which is doesn't mean now that I'm shipping that to we'll say Connecticut, that I'm now absolved of having to count those in my Connecticut sales. That's not, I guess I look at that the same. The title hasn't transferred, or the sale hasn't happened until it gets to its destination, and that's when I'm done with my liability. So for a state like Connecticut that does use destination sales, that would not absolve me of it. In the cases of those states that I mentioned where it's the origin, yep, that probably works in those particular states. And again, there could be a particular rule where maybe there is an exception for a USPS permit in a particular state. I'm not aware of one, but the hard thing about sales and use taxes, the laws are constantly changing. So there could be a state out there where that is a possibility that works. So, all right. And I think we're looking at the tool right now, right? So I'm going to switch back, hopefully.
So while this has all kind of been going on since 2018, and we did this presentation 2.5 years ago, there has been more precedents that has defended some of the states in collecting sales tax. There's a question here: what have members done since then to come into compliance? Would you say the majority are filing, the majority are on the fence waiting to decide? Is it half and half? Is it?
Well, I mean, I'll go again. All I can do is look at my particular client set, and I guess the clients of our firm. And I would say, in general, and again, we're talking about people with sales between that $5 and $100 million level. The majority of them are still kind of waiting and seeing for more chips to fall. Now, again, why is that? I guess I can't answer that for sure, but the states haven't been aggressive about sending out nexus questionnaires, contacting them that. So I think they're aware that those issues are out there. And I guess that could come back to the whole COVID thing too, right? I mean, they were obviously busy trying to tackle all the issues related with continuing to do business during that particular time. And some of them are probably now looking to get in compliance. I know at our firm, we've made it a priority, I guess, this year to reach back out to all of our clients and have another discussion with this on them, just because it's not going away. I think we did when this happened in 2018. I'm not going to say we did hit 100% of our clients, but I mean, we certainly tried to hit 100% of our clients between, I would say, July of 2018 and June of 2019 and make them aware of this. And at that particular time, I would even say my opinion was that I thought that someone was probably going to challenge the $100,000 threshold and say that, that did put an undue burden on small businesses. That hasn't happened. So I think that a lot of people are still on the fence, but I do believe that the majority of people are probably going to start to come along because, well, quite frankly, looking at the prospects of what they're going to do with their business in the next handful of years as well. They're either going to be contacted by the state, probably, or a state, or, they're going to need to transition their business probably to the next generation or potentially, sell their business. And I think that's going to necessitate the advancing of compliance in a lot of cases. So.
Have you seen any complaints or comments on the competitive nature of being compliant versus non-compliant? Certainly there is a cost to putting in the staff and the software and the sales tax that costs more.
Absolutely. And what I'll say is, I mean, the couple of clients that I've talked to that I would say are 100% compliant, sounded like, based on just kind of a straw poll, they probably spent, in their estimation, and in my mind, this is outside costs. They tried to absorb these costs internally from a labor standpoint, but from an outside cost standpoint, I would say it was a $60,000 to an $80,000 investment to determine the states they were going to be in, to vet out and find the softwares that they were going to use and to have those talk to each other. And then it sounds like it's about a $40,000 investment on an ongoing basis is what it sounds like. And again, I guess I'll throw this out there because this person that I spoke with said, if there's anybody on this call that wants to have a discussion with somebody that has gone through and gotten, come in compliance, I'm happy to put them in contact with them. I mean, they said that was fine, that they'd be happy to speak with somebody. So.
Okay, can you share the document that you had up previously when you send the slides that showed which states had which exceptions?
It was the exemption certificate. Is that what we want?
Yeah. The one that said, Minnesota is pretty taxpayer friendly and others are not as.
All right. Hopefully I'm sharing.
Yes, there's a request for this document.
Oh yeah. I mean, so this is easily attainable so if you go, I'm happy to send this document, but basically if you did a search, did multi-state, let's see, actually, you know what? Where did I find this? Well, anyways, I'm happy to send it along in the email with the other materials. And I'll also send the link to it so that they can have a clean copy of it. I can't remember right off the top of my head if I got this off the Streamlined Sales Tax website or if I did a real quick search and found it. But yeah, certainly this is something that I'm happy to provide.
Terrific. Thank you.
Yep.
All right, here's another question. What is the difference between multi-jurisdictional and the streamlined form?
Yeah, the difference is, there is a lot of people, a lot of states that are on the multi-jurisdictional form that aren't necessarily part of the streamlined sales tax group. That's the difference. Let's see. All right, stop share because I'm not sure what I'm sharing. So hold on here. Now, let's see. Now I think, okay, hopefully I'm back to sharing the PowerPoint.
Yes.
Yeah. Okay. Yeah. So there are many more states on that multi-jurisdictional form. Because again, I think there's about 38 of them, 38 of the 45 on there. And the streamlined sales tax group only includes about 23 member states. So I think, I mean, unless there's more questions on sales tax, that is the end of, and I guess people can come back with more questions on sales tax, but I was going to start to delve into income tax a little bit.
There's a question here with acronyms. Does the NOMAD and the SSUTA equal the multi-jurisdictional?
NOMAD. Let's see. I don't know. I mean, I will look into that one. So table that one. I will look into that one. I don't know my acronyms as well as I should, perhaps, I guess. But yeah, if you want to shoot that one to me, I'll answer that.
NOMAD is Alabama, Delaware, Missouri, New Hampshire, and Oregon.
Yeah, okay. If that's a group that's joined together for something, then they would they're different than the streamlined sales tax group then, because that includes more people than that. Now what was the other acronym? The
SSUTA.
SSU. Yeah, I think that is the stream. I think that is the same. That one is the same, I believe, but I'll
Streamlined. Okay.
find that out.
I think that's what she says as well. That is the streamlined.
Yeah, I think that one is the streamlined sales tax group. All right. We're going to touch on income tax nexus now for a little while. And part of the reason is what happens when you get when you register in a state for sales tax, you probably are going to receive a nexus questionnaire. And that nexus questionnaire is going to touch on all different types of taxes. And so for those clients of mine that have been complying with sales tax, the question has come up, okay, now do I need to file? Okay, I'm filing sales tax now in 25 states. Do I now need to file income tax in 25 states? And I'm going to say that the answer is probably not. And we'll talk about the reasons why. So income tax nexus still has that physical presence nexus concept. In other words, in order to have to file and pay income tax in a particular state, and let me take a step back too, just so in general, what I'm going to speak to here is I'm going to speak to, again, I'm talking about small businesses. So again, most of my clients are flow-through entities, they're partnerships or they're S corporations. And again, they're 5 to 100 million in sales. And in most cases, they are going to need to have a physical presence nexus in a state. They're going to need to have property in that state, rents from that state, people in that state, in order to, I guess, get that connectivity with that state where they'd be required to file for income tax. Now, a lot of states, and again, this is a little bit like sales tax here, is that physical presence, they'll ask a lot of questions. And in some cases that can trip you up. When I say a lot of questions, do your employees visit our state for trade shows? Do they need to come here for installation? Lots of different questions that will be on there. And in some states, in some cases, that would create nexus in some states, and some it would not. So just the simple fact that you don't have an employee in a state or property in a state doesn't mean you can automatically go, okay, there's no possible way I have income tax nexus there. You're still going to want to, probably ask a few more questions. Okay. economic presence nexus, as I said, that doesn't apply to income tax, but it does, but it's just income tax. And what I mean by that, for example, and I think I maybe have this on another slide, but we'll touch on this in a minute. But California has a minimum fee. I think they call it a minimum franchise tax. New York has a minimum franchise tax. Texas has their franchise tax. Well, a franchise tax is different than an income tax. So California, New York, and Texas all have thresholds of sales where they say that you need to file in their state. Now, the interesting thing is Texas just has their gross receipts tax, which is a franchise tax. California and New York put these franchise taxes on their income tax form. So you can have I guess in a couple of cases where I've got clients that want to be compliant, we have a very, I would say, I guess, odd looking income tax return because we file this income tax return in, say, California or New York. We don't put any deductions or income items on there, but we pay them this minimum fee because we've got above this economic threshold. So just kind of a weird looking tax return. And then the other thing is that, I do have this on here. I mean, hasn't really happened yet, but, the states are obviously hungry for revenues. And you talk to the experts in the industry that are talking to people in, at various state legislatures. And a lot of them think that a lot of states are going to try to push the envelope and get this economic nexus concept to somehow comply or somehow push down to this income tax level.
So I just want to add, there is one comment about the previous question that says the difference between the multi-state and the streamline is that the multi-state is only for resale and the streamline has other exemption reasons.
Oh, okay, sure. That's correct. That is correct.
Got it.
So thank you to whoever pointed that out. Okay. Income tax nexus. There is something, you do have so in a lot of cases, you've got salespeople that are, let's just say you're in Texas and you've got a salesperson they're going to Oklahoma, they're going to Louisiana, they're going to Arkansas. So you're going, man, I've got this person that's visiting there, on a fairly regular basis. We want them to get out and see their customers. Now, do I have to worry about filing income tax in those particular states? The answer is if it's a salesperson and they are selling tangible property and that salesperson needs to report back to the home office in Texas, in this example, for approval of that job, then Public Law 86-272 says that does not create a connectivity between your company and those states because you are allowed to have a person go solicit in those states for sales of tangible personal property and not have to worry about complying with income tax. Now, it's really important to point out that is tangible personal property. So if you're doing, some of you may be doing things such as creating websites for customers in states. You may be doing other things that are more service related. Well, this Public Law 86-272 only covers tangible personal property. So if you're doing some of those other things, you need to take a look and see, okay, does that get me to a connectivity level where I do have to worry about income tax in this particular state? Yeah, and I think I talked about this, but this only protects against income tax, does not protect against kind of like the whole physical presence versus economic nexus. 86-272 only protects against income tax. It wouldn't protect against franchise tax or the gross receipts tax in Texas. Yeah, other taxes, and these taxes aren't protected by these. Yeah, one other thing I wanted to talk about, I'm going to go back to this slide. So I'm in Minnesota again. So this is where, I guess when I talked about sales tax, I talked about the whole technical versus business standpoint. If you're in Minnesota and our highest individual income tax rate, and again, I'm gonna assume that most of you out there are flow-through entities, your S corporations, your LLCs or partnerships. If you are in a Minnesota company and you are selling into some of these other states and you have any question as to whether or not you think you've created nexus, in a lot of cases you go, well, probably not necessarily a big deal for me to file in some of these other states as a Minnesota business. Why is that? Well, in Minnesota, we have the highest income tax rate of 9.85%. So if I come to one of my clients and I say, hey, it looks like maybe you should be filing income tax in Illinois and Iowa and a couple of other states, and they're like, all right, well, what's that going to cost me from a tax standpoint? And my answer would be, well, it's really probably not going to cost you anything from an income tax standpoint, because for any tax that you pay to Illinois or Iowa, you're going to receive credits in Minnesota against that tax. And since we have a 9.85% rate and Illinois has a 4.95% rate and Iowa has a 6% rate, you're not going to pay any more income tax. You're just going to pay us as your tax preparers, some additional fees so that you're in compliance. So for a Minnesota business, not the toughest decision. For a Texas business, probably a much tougher decision. No income tax there. So again, now if I'm wondering, man, I'm really nervous about, what I've got going on in, Louisiana or Arkansas or Oklahoma. Well, now I am just flat out adding additional taxes at whatever rate that is on top of, the gross receipts tax that I'm already paying. So, again, I guess I always try to give my clients the technical answer, and then we try to drill down and try to make a good business decision. Just something important to remember. And I think, yeah, that's all I think I had on the income tax. So, Teresa, Ben, I don't know if there's been any other questions that have come up or not.
I think we answered those that are out there, but of course, now is the time for our attendees to put your additional questions in there. If you were waiting for it to be presented on, now is that opportunity. While they're doing that, Rob, I certainly want to go back to that conversation we started with, which is, are our members at a disadvantage? And if you have those that are doing nothing about it, they're not passing on the sales tax or putting in software or staff to be compliant, then their costs are lower. Even the final bill, because you don't have the sales tax added on there. And so if you're bidding against your competition, are you impacting your ability to win the bid because you're trying to be compliant? And it almost seems unfair.
Yeah, sure. I mean, the bottom line is you shouldn't be. And that goes back to, there was a slide, that I had near the beginning where it should not create a competitive, disadvantage. But that is assuming that your customer then, so you're currently not complying, you're selling to somebody in a different state. Technically, if I'm that customer and I am the end user and I'm supposed to be charged sales tax by you and you are not charging me sales tax, I am supposed to self-assess use tax. That doesn't mean that our customers are, but if you're ever bidding for new business, I guess that would be the question to ask. Because there should not be. I mean, if my company, Teresa, and your company's price is the same, but I'm charging sales tax and you are not, on the surface, they would see that and go, oh, okay, well, I should go with Teresa because her price is cheaper. But the bottom line is they should be self-assessing use tax. And if they're not, they have a liability that's hanging out there that they're liable to get, charged on if a sales tax audit were to come up.
Yes. Okay.
So yeah, I mean, but again, I'm not naive to think that doesn't happen, and it does happen, and that can be the conundrum. Yeah, I mean, you're trying to do business and you're trying to make a business decision. So I guess that's why you just want to assess what is that liability in each state, keep track of what that is so that you can determine, all right, at what point is this too big and scary of a number where it's not worth me retaining this business where I'm, my gross profit is X and my overall profit is Y, by I guess avoiding this potential liability that could come up at any point in time. So,
excellent point. There is a question. Effective July 1st, Minnesota implemented a retail delivery fee. What are members doing about that?
I will admit I haven't polled too many of my members yet, or many of my clients yet, to see what they're doing about that fee. I think it's a 50 cent fee per transaction. Yeah, I unfortunately haven't polled them to see what they're doing with that. But I would imagine, I would imagine that a fair share of them, because of the amount of it, are maybe ignoring it at this point. Not because it's going away, but just because it's new and it's not a big fee. I guess, and my point to that is, obviously I've been through a fair number of sales tax audits with my clients. The lion's share of them have been in Minnesota, probably 90% of them have been Minnesota. The others have been probably in Wisconsin, a neighboring state. And I guess it's, when someone comes out to do a sales tax audit, they're probably going to find something. You can, and this is me editorializing, and I'm not trying to tell you that you shouldn't be compliant with this new law, whoever asked that question. And I'm not trying to tell you that you shouldn't be compliant with any laws, but at the end of the day, there are so many different laws, rules, regulations as it comes to sales tax that I think your goal is to be as compliant as you possibly can without creating too much of an administrative burden, knowing that when you're audited, you're probably going to end up paying them, some small amount of additional tax when they leave.
Okay. So really it comes back to that. What's the liability risk?
Yeah. Yeah. And like I said, it's new. It's not I guess I didn't look to see what Minnesota saw. They thought that was going to be as a revenue raiser. But it's 50. There's a lot of exemptions from certain things that are shipped where you don't have to charge that fee. So yeah, I don't know that I've had a lot of, well, I know I haven't polled my clients, and I know I haven't received any particular questions on it as of yet.
Well, and while it's new in Minnesota, we do know that in the Midwest, Minnesota down to Texas, many times legislation that happens in one state eventually gets picked up in other states in the same area, much like the case of Wayfair and South Dakota, which has now become implemented in every state. And so it could eventually impact all of us.
Yeah, if one state comes up with a good idea on how to tax something, another state would probably go, hey, that's a good idea. Now, there's certainly, the good news is there's obviously some states that are more tax friendly than others as well that maybe won't go down that road, hopefully. So,
right. We can hope. Certainly, the print and packaging industry is made up primarily of small businesses, those sole proprietorships, partnerships, LLCs. And so it's always concerning for more burden to be on the business and the government to put more compliance or regulation requirements on the business. So it's something they all have to be thinking about. And you made a really good point that we still have a lot of baby boomers involved in owning those businesses that eventually has to transfer.
Right. Yeah. And that's why this is probably a fair topic, and one that, again, I'm not into scaring people. It's just, if you're going to do something with your business, transition it, this issue will come up. I can guarantee that.
Mm-hmm. I do not see any other questions. So now is your last chance to type in a question. Otherwise, I think that we'll be able to end early today. I know that several have asked for those resources, and it's probably going to allow them to have additional questions. With that said, once they receive the template and the documents the recording of the webinar, can they reach out to you directly? Should they go through PIM and Mid-America?
They can absolutely reach out to me directly. I mean, at the very start of the slides here, I've got my phone number and email address. Either way is fine. You know, I just ask that if you hit me with some questions, be patient. I'll try to get back to you as quick as I can. I'll acknowledge that I have your email, and then certainly give me a day or so to get back to you. So
excellent. Terrific information. I was really thrilled when I heard we were going to do an update to the webinar we'd done a couple of years ago.
well, that's good. I mean, it's not often that I hear thrilled and sales tax in the same sentence, but so, you know, that's good.
Yes, I hear you. It is not the most exciting topic, but it is definitely important.
Yeah, agreed.
Okay. With
All right.
that said, we're going to end 15 minutes early. Thank you for your time today and for the research and information that you prepared. Hang on, maybe one more question. Oh, we have one that we're going to add, so we can do that. And then a thank you in all caps for the information. So we appreciate you.
Not a problem. Happy to do it.
Excellent. Everyone have a great afternoon, and we'll get you out this information as quickly as possible.
Thank you.
Thank you. Bye-bye.
Bye.